Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
Hello, everybody. Welcome back to another episode of Show Me the Money, Unlocking Property Finance. For those of you who are new listeners, have not heard this podcast before, my name is Sharma. I'm a property developer and investor based in South London. And we also have Marc, my co-host. And Marc, just remind everyone who you are and what you do.
Yeah, my name's Marc Champ. I'm the owner of Wolf Financial, property finance brokers. Also do some property investment on the side. So I've been around property for probably 20 years or so now. But keen to learn more from the guests that we have on.
Fantastic. And today we're really excited and super pleased to have Matt Kerchner, who is a relationship manager at Pivot, who's got a really interesting background history, is also has become a good friend of mine. Started with us doing a bit of work together a little while back, but we're really pleased to have you on, Matt. Welcome to the show.
Thanks for having me.
Great. So just tell us, we'd love to hear a little bit about your background, what you've done, and then we'd love to hear a little bit more about what you're doing right now as well.
Sure. So background is, forgive me because I'm an American. But actually the British do love me because I pay taxes, but I can't vote. So I'm good friends to everyone here. So background is I moved here about 4.5 years ago, working with a group, small family office, based in the States, called Quanta Finance. Quanta from the States were a family office based, but a development bridge lender that had its ties from prior group. It was called B2R, which is a Blackstone funded group. So a bit of an ancient history. So the group actually started, and I worked with them since about 2018. But the group started as part of a Blackstone funded group that was acquiring single family rentals and single family homes in the States. And some of the directors I worked with bought, I think, about 3,500 single family homes during 2012 to 2016. And some of that initial capital kind of stayed with us and was kind of spun up into Invitation Homes. So Invitation is one of the biggest owner operators of single family rentals in the States, and I think the world. They're listed now. They have about, I think, 45,000 rentals. But anyway, so that's kind of where the group started. I moved here in the UK because we have the U.S. institutional funding line. They were generous enough to let me open the business here and start investing here. So learn the business and kind of learn some of the market here. Since then, some of the directors actually left, and I wound down the funds here. And so I'm actually with a new group now called Pivot Finance. Pivot Finance, another development lender, bridge development lender, and we kind of do a bit different from one of my previous experiences because it's a little more broader, products and broader assets we'll lend on. So that's I'm pretty excited to be started with them.
Fantastic. Really interesting history. I guess one of the first things, what do you see as the main differences between how things are done in the States and, I guess how we work in the lending landscape here in the UK?
So the biggest thing I think between here and the States is it's really just the frictions of not just the completion process, the completion conveyancing process, but just the frictions of everything. For example, if I'll still do still talk to a lot of people in the States, and at the appropriate gearing, let's say checks all the boxes. I know the person, just a straight bridge on a residential asset. They say, hey, I need to complete tomorrow by 5 p.m. and I want 50 LTV. And I say, okay, fine, we can do it. So it's just really the completion process. And a lot of it is with land title law here versus there. In an old property in the States is 100 years old. Whereas, here you have land title law going back to, kings, basically back to kings and monarchs. Or even the house I'm in would probably be the oldest house in California. I think the house I'm living in now is from the late 1800s. I've actually done a few properties in California and Hollywood that were from the early 1900s, and that would be considered young here in England. So it's really the kind of the conveyancing completion process is really there's a ton of frictions here, which I know Marc will probably Marc will say. I mean, it definitely working with a good solicitor here. Like I know he's had Tariq on previously. He's really good. And I think just to kind of get to the completion process, and I think is the biggest thing that I've seen.
So what do you think they can do to speed it up then?
I mean, how much time do you got? I mean, I think the biggest thing is, so a lot of people, I mean, Pivot as well, we work with title insurance. I mean, that can speed things up a lot. I mean, another thing is when you're a borrower or developer, make sure your counterparty is also, if there's a vendor involved, make sure that they know what they're doing. For example, me as a lender, I've actually had and I've asked multiple times if they can act for multiple parties, but it's kind of an SRA thing with a conflict of interest. But in the States, for example, you generally have a title and escrow. So basically you have search insurance, you have a title insurance, but you're going through one party, for example, in California. Whereas here you have your vendor solicitor, your developer buyer solicitor, and also me as a lender, you'll have the lender solicitor. So you could have, multiple solicitors involved, and it just it gets really messy sometimes. I mean, as you know. So I think definitely work with, I'm going to assume, lender solicitors are know what they're doing, but also as a developer, make sure that all counterparties involved are really property specific kind of attorneys. I think that's important. Like I said, Tariq's actually is really, really good. And to have as much as like kind of your legals and everything done ahead of time, so that by the time then when your kind of lender solicitor asks for those check boxes, here's a Dropbox of all the information. Here's
Yep.
of our legal pack that's already been kind of pre-filled out. I think as much work as you can do like ahead of time, I think helps speed things up.
Yeah, I totally agree. Getting everything prepared and also making sure there are no surprises. If there isn't planning permission, tell the people up front there's no planning permission and things like that, because not only does that annoy the lender, but the solicitors then have a job to get the right indemnity insurance in place, whatever it may be. It's it can really slow things up.
Yeah. I mean, I'd love to. I mean, this is a topic for another discussion, but I'd love to privatize the planning process here, similar to like building control. I mean,
I think we would, yeah.
Have a profit motivated companies behind it. Actually going through the planning process, I think would help a lot too, because that's as a capital investor, it's pretty. I've seen guys that have taken 5 years to get through planning, and that's. I don't know how you figure out kind of a net present value of what my return is going to be when it's a question mark whether I even get planning. So that's I mean, I would push that, your friends in government, Rob.
Yeah. Let's see what we can do. So tell us about Pivot then. What is the focus of Pivot? What kind of lending do they typically do? Target profile of borrowers?
Yeah, so Pivot is so we're funded by some kind of larger institutional investors. We actually just got a couple new credit funding lines. Kind of our specialty is that to be upfront, we're not the cheapest in the market, but what we'll do is a bit higher gearing, kind of more of a bit of a stretch senior. So we'll go up to like 70% of GDV on even a ground up development, and up to 90% of cost, and even a touch higher with. We work with LDS a lot and kind of on that sales guarantee scheme. So we can do a touch higher even on loan to cost. We'll do things that are a little bit more exotic, as land with planning. We'll do commercial bridges. We'll even do kind of a commercial exits and things like that. And we'll allow like kind of mezz to sit behind us and consider. I can kind of take a view on some things. Generally, our credit committee meets twice a week, Mondays, Wednesdays. Smaller loans under 3 million doesn't need to go to kind of our capital partners. And kind of our target loan size is between 1 to 10 million, but kind of we find our sweet spot between 3 to 5. Trying to do a little bit more larger deals, but that kind of 3 to 5 spot is we found to kind of be the sweet spot.
Okay, very, very helpful. What I think one of the things that we are really excited about when we have people like you on the podcast is that you can really give us the kind of the inside track and that, to understand the nuts and bolts of how decisions get made, what good deals look like, what bad deals look like. Because I think for a lot of borrowers or people who are, and Mark, I'm sure, sees this all the time, applicants putting deals forward which they think are the best things to slice bread and that should be funded easily at high leverage. But we all know that the reality of it is often not quite that. So tell us a little bit about your approach and, drawing upon your vast experience and possibly with what you're doing today as well with Pivot. But tell us a little bit about your approach to due diligence and what makes a good deal, what makes a good borrower, and how you kind of make that assessment before taking it forward.
So I think I used to just to step back real quick before kind of going over approach. I think what I think for developers to really understand is like to put yourself in the lender's shoes and really why are they, and Marc will say, well, why are they so, why is everyone so conservative? Why is everyone so skies are gray? If you think about it as a lender, our upside as a lender is because everyone has a cost of capital and overhead and everything. So upside as a lender is, your margins are anywhere from 2 to call it 5%. And your downside is a loss on the loan book, and the loss on the loan book could be 20, 30, 50%. So just something to keep in mind, I guess, when you're getting pushback from a lender, I guess the number one rule of lending is kind of the Warren Buffett rule of don't lose money. Again, because maybe max upside you're going to make on a deal is 2 to 5%. Because like I said, everyone kind of has a cost capital at either funding line or a certain funder. And I guess just to keep in mind on that. So when I look at lending and kind of my process is generally when either developer or borrower or broker kind of start looking at a deal together, I assume that a lot of the things are kind of check box, good experience. Usually someone already kind of knows if they're coming to a development lender, they already kind of know what a development lender will look for, experience, decent credit. For me, like I want my real process is, and I think it like really helps speed things up is I want people to kind of just tell me the quiet part out loud. In generally, I mean, if you're kind of coming to development lender, it's highest geared and lowest price, but the quiet part out loud is maybe it's I have an old CCJ or have a old company that's in administration or maybe the GDV exit values are a bit punchy. Okay, great. Like it's usually and lending for me breaks down to more of a qualitative like what are kind of the main bullet point risks, and something that you can, because a lot of the things will kind of get flushed out in due diligence, like kind of your background, credit history, past projects, things like that. But it's usually like there's as you know, Ro, I mean, there's like a 1 to 3 things that are kind of have to get that qualitative over the hump. And so I like to kind of like find those kind of 3 bullet points to really just get over the hump. And then back to what I originally said of, why are lenders so conservative? How do we mitigate that downside? How do we mitigate basically any downside risk? Because my downside needs to be 0%. My upside is 2 to 4%. And that's just kind of how I approach it. And I just try to cut through as much of it as quick as possible.
Yeah, it's when we have a customer come to us, they're the sorts of things that we try and flush out before it would get to the lender, because there's so many variables, and they always have to come out in the wash. They always do. So it is a matter of saying to the customer, let's get everything on the table now, find a lender it fits with, because they're different lenders with different risk profiles. It really does make sense to do it early on, because The worst thing is getting down the line, valuation done, and then you find something a bit later on, because it wastes a lot of time and a lot of money. And usually the customer becomes very upset, even though they could have divulged a bit more information up front. So
Yeah, and I guess on that note, I mean, my approach is, those few things you met, those bullet points that are going to be like the main risks. Like I'm looking at a transaction now where the main risk are he's low on one of the developers is low on working capital and GDV is punchy. So I say, okay, great, like I'm happy to spend your money on evaluation and a third party kind of IMS report. However, valuation's punchy. If it comes back lower, can you come up with more money? And he says no. I say, okay, then I don't want to spend your money then. And that kind of solves it. So I don't like spending people's money and I'd rather kind of I'd rather spend my own time, do a bit of diligence and a bit of digging to say, is this going to kill the deal? Yes, it will. Okay, then maybe get another quote from someone else, basically. Because that's just kind of my approach.
Yeah, Ro, as an investor yourself, how do you see it? Is it something that you would try and, I don't know, if there was something sort of a little bit not massively important, but something that could go either way, would you mention that up front, or would you hope that it wasn't noticed, or there was something that could be done later down the line once the deal was in, it was sort of going along, and it's harder to turn down then because more people are invested in it? What's your thoughts?
Well, I mean, having been through the process a few times, I know it pays dividends just to be upfront and have those difficult conversations earlier. Because my mantra has always been get to the know earlier, rather than enduring all the work and effort and cost and expense. And not just with lending, but when I'm talking to landowners or site owners as well, if it's a no, I'd rather find out earlier and save all the time and heartache rather than go through the process. And as you say, people might be more invested in it, and you might, if you're lucky, get to a situation where people are also invested that they just want to get it over the line regardless. But in reality, I think that very rarely happens. And I think, as Matt has said, when you've got lender due diligence involved, you've got multiple strands of checks and parties involved in doing that due diligence. It's not going to wash, especially when it gets to the solicitors, because then ultimately then it's got to be advised back to the lender or the underwriter, and then they'll take a view. But unless they've been aware of it up front, it just upsets everybody. So yeah, I very much try and get all the cards on the table with everything that I know up front.
Yeah, and it's not. I mean, when I say cards on and say the quiet part out loud, it's not always a bad thing. For example, Ro, you mentioned in, I think it was episode 1, you said, why are your costs so low? It's because I'm using my mates rate. I'm getting mates rates, right? Or my cousin's building for me. Great. Just tell me just tell the lender up front, because the lender is going to do at least some kind of cost appraisal on their own, and the lender, again, they're in any kind of bridge, a bridge or a development is an intermediary product. It's a short-term intermediary product. It's not a term loan. So how do I, and this is kind of how I've been taught, is how do I force that exit? How do I make sure that the exit is a clean product that's either ready for sale or for rent or remortgage, and that's a liquid product, right? And that's a liquid project. But if we're undercapitalizing it, we're not reserving enough for construction draws, things like that. But bro, you're getting mates rates, like you said. Just tell me, just be upfront about it, and then I go, okay, then something you can work around it. And myself or any other lender, you'll say, okay, great, we can figure it out. Maybe we can reserve a bit more. Maybe we'll increase the loan in the event that your mate isn't your mate anymore, type thing, and you actually have to use kind of a third-party contractor that's going to have a 15% profit margin for him. Things like that, just to, like I said, because these things will always get fleshed out in diligence. It's just, do you want to spend 6 weeks or just 6 hours kind of getting that fleshed out?
Yeah. Tell us a bit about your due diligence process then. So once everything has been put on the table up front, tell us a little bit about what goes on at the next stage, and what sort of things that we as borrowers and as investors, developers need to be aware of to kind of manage our expectations?
So it depends. I mean, like, so if, like I said, if, for example, with Pivot, it's under 3 million, that's credit committee. So it's like twice a week credit committee, as long as it fits within, loan to value guidelines, I can kick that straight to underwriting. If it's something bigger, and you guys talked about this a bit, earlier about, or I think it was on previous episode, is like, what is driving the lending decision? So for example, and just to be upfront, most lenders will either have to go, if it's outside of their kind of straight parameters, like balance sheet lending, they have to talk to their capital, to their effectively to their funding source. So same thing at Pivot, if it's over 3 million and they want to be over 70% GDV, that usually is going to go back to our funders. So again, for my decision is I want to I'll have to do a kind of an initial credit paper, just initial diligence of who the borrower is, what the project looks like. And then we have usually it's Wednesdays, we kind of have our credit meeting. And again, I like to do these things before spending funds, but I think again, as a developer, to ask these questions of like who the lender is, kind of in quotes you're actually talking to. And I know Marc said, like, what does the funding trail look like? And where are the funds coming from? Because at the end of the day, every lender has a certain funder, certain cost of capital. I know Marc was saying that Shawbrook funds 30 bridgers and JP Morgan funds a handful of others. And just I think it's a good question to ask, your relationship manager as a developer of like, is this within within kind of like credit's decision? For example, with Pivot, 3 million and under, that's credit's decision Monday, Wednesday. I can basically give you a thumbs up and move it to valuation and start collecting further diligence. If it's over that, or if it's kind of outside of guidelines, it's just got to go up to basically our bank funding line, just to give a 2 cents on it. Most of the time, I mean, we know the bank funding line, we know like their appetite and everything, so it's not like I'm shooting in the dark, but it's just a good thing to keep in mind. That was just a note. Actually, I remember listening on your prior episodes, but
So how many people sit on your credit committee then?
3 people.
3. And does meeting Monday and Wednesday only put you at a disadvantage to some other lenders that have credit committee every day and potentially could get a quicker decision to the customer?
I don't really see that. I mean, I can always pick up the phone, or I mean, I sit next to them, so I mean, I can always just have a chat with them. And uh, in terms of things, I mean, for example, I did one yesterday. I sent out terms, got it this morning. I sent out terms. I just had a quick question, say, hey, 65% commercial bridge purchase, or we're good to issue terms. Yes. Okay, thanks. That's I mean, that's how quick the credit committee was.
Yeah.
So I mean, it just depends. I mean, that was 1.5 million done kind of Portsmouth area on a commercial light industrial purchase.
Mhm.
Actually, owner occupied user that we're getting actually a bit more loan to value, because I think you may buy it under market, because we can go up to 75% of cost on that, lesser 75 or 65 of value. So so yeah, that was the credit committee meeting. I mean, if it's usually I say meetings more Monday, Wednesday, if it's like a little more nuanced, multiple pieces of collateral, different borrowers, PG, no PG, like things that I think a bit more nuanced.
Yeah.
So I would say no, but I mean, I can always like make meetings if needed.
Yeah, no, and I think the initial interest is what the customers are looking for more than the actual firm decision to start with. They just want to know from us as brokers anyway that you've got a lender or a couple of lenders who are interested in it and the project is viable. Then getting all the information together to provide that to a lender can take a little bit more time, which is fine by a customer. It's usually the initial heads up whether it'll work or not, I would say.
Yeah.
And generally speaking, I guess when you've got something that is of interest at the beginning, what are the sort of things, so let's say, I come forward with a deal, a concept that Marc has been through. Marc will introduce it to you as the lender. Sounds good. Sounds good initially, but then what are the sort of things that when you start digging deeper that can actually work against you, assuming that you've got a good borrower with a good profile and there are no kind of skeletons in the closet? What are the sort of things that you do see tend to actually trip deals up, even though they seem good at the beginning?
I mean, just I guess the biggest things that or see deals be tripped up is again a lender. I want to see, how do I get to my exit? My exit is a fully funded project. So okay, are your costs kind of within line and your GDV valuation, and does the story make sense? If the exit is a liquid exit to where multiple refinancing lenders, multiple people are, well, there's multiple buyers in there, great, and costs are in line, great. I mean, I like to, I mean, the biggest thing is just kind of keeping with I guess the flow and keeping the story of assuming borrowers clean, like you said. I like to really look at just kind of how do I, like, at that exit, because at the end of the day, Pivot or anyone else in the bridge or development space, asset-based lenders, little secret is that the PG doesn't really mean anything, because I've never seen anyone really collect on a PG. So if we're really trying to collect on a PG, it's we did our underwriting wrong, and underwriting in terms of the actual asset, the actual project. And it's just like I said, it's the story of whatever project you're either acquiring, adding value to, getting to an exit, of making sure those values and kind of like the cost stack up, and the story stacks up of how you're acquiring the project and how you're going to exit the project. And again, back to what I said, if just to be upfront, I've had people to say, hey, I'm buying this for £500,000, and it's like, well, I'm really not, because the landowner's going to JV with me. Okay, great, just tell me that up front, because I can work with that. But if I don't find that out until it's in underwriting, and underwriting is now panicking because it's 100% loan to cost, we just wasted some time and probably some money on evaluation. So it's really just kind of making sure the story makes sense, making sure like everything just kind of checks off in terms of really the asset and the exit.
Yeah, it's interesting you say that, because when we look at a deal, we talk to a customer about a transaction, we always do it backwards. We look at the exit and then work backwards, and then see what contingency they've put in, and what other provisions they may have made. Because a lot of the time, if you go the other way, you could do a whole lot of work and then it fall over. It's the exit is probably, it's obviously the most important thing. And with the rates, it's not so much now the rates coming down, but with the rates going up, last year it was very difficult to ensure that there was an exit and get everybody comfortable with it. So luckily hopefully we're going in the right direction.
Yeah, I mean, I think actually that's a really good point of, if for example, Mark, you say my exit, I'm building 10 flats and my exit is a hold and I'm going to get a term refinance. Okay, great. Have you looked at what the term refinances look like, and what you're going to value that on a capitalized value? So if you say it's way up north and I'm going to get a 5 cap, or a 5% net yield on this investment, and I'm going to get term refinance at base rates plus 0.5%. That just doesn't work, right? I mean, like I wish it did, but it just doesn't work. So just to really know what, again, me as a bridge or development lender, is I'm going to have to see, like, okay, so you say your exit is a term refinance. What does a term refinance market look like? And does that exit actually make sense? And the one thing actually I will say too is actually is to really, as a developer, just another tip is just to really know your deal. And to be fair, I'm an idiot American, so when me sometimes as a dumb American knows more about your deal, like, it doesn't really feel good. So I'll give an example. Did a PD conversion down in the South Coast. Really good borrower, good build and everything, but he was building a lot of studio units. And I did the diligence. I spent a couple days, and I said, mate, why are you building studio units? There's no the university's not close enough. There's not a single studio within like 3 square miles. Um, and look, I'll push the valuation, but like your unit makes sense. And so he argued with me, went back and forth. Um, and the valuer actually, so he spent money on the valuation, and now the valuer said the same thing, like your unit mix doesn't make sense. And so actually it actually turned out we completed the deal, and actually we funded the deal and everything. But what he ended up doing was changing a lot of those studio units to either 1 bedroom or a mix of 1 and 2 bedroom units. So we went down from, I think, 40 units down to about 33. But it's a complete, I mean, that's successful, but to really, I guess, know the deal, like, because you're going to have people that are going to be looking at it kind of from that not as a constructive lens, what is, what can go wrong with the project, and what so definitely know the deal as a developer, know the area. I guess another tip is, when I was doing actually acquisitions for a large multifamily developer in the States, I would physically go and actually visit properties. I would pretend I was a tenant, even if I was actually a bit younger at the time, so I could pretend to be a student. So we were doing a lot of student accommodations. So I would physically go and say, hey, I want to rent a room, and I'd take photos, and I'd go to all the competing sites. I'd go to every single competing uh, asset we were going to go to, or I'd put a hard hat on, say, because we did some industrial too. Say, hey, we're doing light industrial, like warehouse, like as a tenant, like I want to lease this space. And so to really get an idea of, I mean, physically go to properties and really know the deal. And why, and if you're going to present to a lender, like why that is, and don't let like a lender, like me, a dumb American, really figure something out for you. I mean, I want to be the one that's being kind of educated on your deal.
Yeah, and that makes complete sense to me. We had one the other day we were doing, and it was for a serviced accommodation, and the property was in Coventry, and the lender was like, why are you doing a serviced accommodation in Coventry? It just doesn't make sense. You shouldn't be doing it. But we've done quite a lot of serviced accommodation in Coventry, and what the lender hadn't realised was that there's 2 universities in the Coventry area. There's a large hospital in Coventry. There's a lot of manufacturing that happens, and the serviced accommodation isn't for people going on holiday. It's for people to visit the university, use it when they're working at the hospital, whatever it may be, or visiting people at the hospital. So we put that to the lender, and the lender got comfortable with it. They said, yeah, do you know what? You're right. Get comfortable. We're comfortable now. So I think just a little plug for brokers there, making sure you've got a broker who understands the investment and what lenders are looking for and can preempt any questions like that is really important to any transaction.
Great advice. I've got one more question actually, Matt, just in the last few minutes before we wrap up. What are the changes in opportunities or propositions that you're seeing? Are you seeing particular opportunities where people are capitalizing on certain types of investments? What have you seen as the biggest changes in the last sort of six months, say 6 to 12 months?
It's interesting. It's almost I'm seeing a lot more inquiries right now, which is good. I think people are a little more comfortable with where the rates are at, and because they can, without really the volatility, I guess, in increase in rates. I mean, we got to think about this as the fastest increase in rates I think that has happened, I think, ever. And not just that, it's not the actual absolute value of the rates, but just the increase in rates from basically 0% to 5%. That how quickly that happened. So I think people are a little more comfortable about, I guess, where they can kind of get term debt, which is good. A lot of the term lenders are kind of back in the market. Chat with Marc on that, but I mean, it's interesting. It's almost a bipolar market, because I speak with some administrators, development managers, lenders as well, because everyone kind of knows each other. I haven't seen the market where lenders are actually taking back, repossessing properties right now, and things are going sideways.
Yeah.
With cost overruns and things like that. There's a lot of that not a lot. There's some of that in the background, whereas at the same time, I'm seeing people still spend a lot of money, and vendors haven't really, they're starting to, but haven't really kind of come to the point where they're really decreasing their kind of land prices, or whatever the existing is. Um, so it's interesting. It's a bit of a bipolar market, but I'm still seeing, like, I mean, there's definitely opportunities in terms of I think the rental market. I've seen a lot more people kind of move towards rental exits and kind of term exits, just because rents have increased to the point where I mean yields aren't actually kind of make sense in certain markets. I've seen people a bit more cautious in just terms of like the for sale exits, just because I guess just with current mortgage rates on retail buyers buying homes. I mean it's just gotten a bit expensive.
Yeah.
So kind of rent versus buy question is it sometimes doesn't make sense. I mean, if you just look at what is the cost of a rental, if you're just going to go rent a flat versus, I mean, to buy a flat, what does the rent versus buy look like? So that's why it's giving a lot of people more pause in terms of the for sale
Yep.
exits. So I'm seeing more people do kind of more HMO type stuff, rental accommodation type exits, which is good. And the one thing I actually really like to see is people doing, I guess, a lot more, getting more creative. I know, Ro, you were talking about getting creative with different landowners and doing more like kind of JV opportunities where landowner contributes the land and you contribute kind of your expertise and build costs and stuff to exit. So that I think I'm seeing a bit more of that, people be a bit more creative with vendors if they're if they're willing to work with you.
Yep.
But still, it's like I said, it is interesting. Still, there's still a lot of money out there chasing, uh, good deals, to the point where I've actually even made a couple offers on a project over in Ascot, another project in Barnes, but just was bid out to the point where my profit would have been pretty effectively zero. So it's interesting that there's still a lot of money out there, whereas at the same time it's almost bipolar, where in the background some lenders are taking some losses right now. So it's kind of interesting.
Very good.
I'm
Great.
curious on actually on your guys's too. I guess, where do you guys see a guy that I've followed for a while, Don Cox? He said never invest on page one, invest on the basis of what's page 16, and going to page one. What is I guess what are you guys seeing in terms of where do you see opportunity? Where do you see potentially something's going to be page one in the next 6 to 12 months?
So we did a podcast with Joe from Handelsbanken a little while ago. I'm not sure if you've heard that episode, but
I did, yeah.
Yeah, he was talking a lot about the energy performance commercial units and the baby boomers who have owned these properties for a long time, just not having the drive to want to get it up to the right energy performance levels. So these are coming on the market at below the value that people potentially expect them to. So we see that as an opportunity. That was very interesting from Joe. But what I'm just seeing so much of the terrace house to HMO conversion still. It's just where everybody wants to be. And also the serviced accommodation. Now that buy to let is harder to achieve a profit, just vanilla buy to let, they're looking for another angle. And the serviced accommodation is where people are really looking for a little edge. But the problem is there are very few lenders that will lend on a serviced accommodation basis. And if you've got a first time investor looking to get into serviced accommodation, you're probably going to pay at least 1% more than you would do on a HMO. So it's quite expensive. Not many lenders like it. And to be honest, the people who are investing in it are probably the lesser experienced people. So there's probably going to be more chance of them going wrong and causing lenders to pull out the market even more. But if it's done right, then yeah, you can achieve a lot better yield and some better profits. But I think it's a risky strategy.
Yeah.
Yeah.
Makes
Yeah,
complete sense.
I think you're hitting on what I've seen too is inflation is remaining sticky. So I mean, you said terraced house to HMO conversion. That means that people are basically moving down market, right? And there's a huge demand for affordable housing, which is ironic with inflation staying sticky is actually helps that developer because I mean you can actually get better yields on an HMO. And I know and Ro knows too a couple guys that do have actually pretty big HMO portfolios and they have waiting lists right now. Just because the affordability of an HMO or just any affordable priced unit is it's just attractive right now. So yeah, I think you hit on it. Yeah.
And I think for me specifically, I'm looking at long-term income generating assets rather than stuff where I'm putting them on the market to sell at the end of development, just so that I don't have to be exposed to the sort of market risks there. It may sort of change my capital requirements longer term in terms of money left in the deal, but that's just a far safer bet for me. Unless the deal is just really, really good. I'm doing two things: buying to hold for long-term income. HMO strategy is great. But then also, if I'm working on a joint venture basis with a land or a site owner, that's more likely to be something to get planning on and then sell it on rather than exposing myself to the sort of the market risk after building it out and where the only exit is to sell. Because I think some people who get forced into renting their assets at the end where their primary exit was always to sell, it kind of changes the mechanics of the deal, the structure, and I guess, the actual deals that you're looking for in the first place. So I'd rather, set out with plan A and be able to execute against that rather than having to work on a plan B all the time. But having a plan B is always important.
Yeah. Yeah, I mean, look, I'm still very positive, UK housing and I mean, in general, I mean, the under shortage of supply is acute. And just the planning process, again, back to what's different in the States, the planning process here is I just don't see an oversupply of inventory. I mean, maybe Battersea, Nine Elms, maybe parts of Liverpool and Manchester potentially, but there's no one's going to drop 1,000 units of supply on the market. You're not going to see you can go on the planning portals, you can go on Land Insight and see what's in your area, what planning is permitted to coming up. But in terms of actual like housing stock, there's just I'm definitely perspective on and positive on just housing, affordably priced housing in general. And to be fair, I mean that's why you've seen a lot of large actually institutional funds like the Starwoods, BlackRocks or of the world, Fortress basically setting up built to rent rental products here in this country just because the yields make sense. You can, and it's just an acute housing shortage of it's going to keep unfortunately for us renters going to keep rents probably pretty steady and trending upwards for the foreseeable future.
Indeed. Brilliant. So I think we'll draw to a close here, but Matt, thanks so much for being our guest there and sharing all your insights. It's been really, really valuable. If people want to get in touch with you, what's the best way for people to engage?
My contacts I believe it's on the Pivot website. Pivot's fine. I'm actually LinkedIn's fine. Pivot, LinkedIn, or I'm actually do a lot on Twitter as well. So any spot. Ro has my number, so you're going to give me a ring.
Yeah, fantastic. Well, we'll leave some details in the show notes. And as ever, for our listeners, if you've got any questions, comments, or ideas, suggestions about what you'd like us to cover to answer your questions, then please do get in touch. Again, details will be in the show notes. But from both myself and Marc, Matt, thank you once again, and thank you everybody for listening.
Thank you very much.
Appreciate it.
That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media, where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance.